Yeah, no, it's all right. But if so, how would you describe your trading? Is it more based on technicals? Because I know on
No.
Premarket Prep, you guys are covering news, what's happening,
Yeah.
where you see the markets going. How much of that do you account for in your trading, or at least worst case, what stocks to look at?
Information arbitrage, a lot of information arbitrage. What that means is taking information, it's publicly available, whether it be through Benzinga Pro or Bloomberg or wherever you're getting it, and then analyzing it and coming up with, conclusions from that information. I mean, it can be as simple as, okay, the stock is upgraded, it's been in the gutter, that's probably going to kickstart this stock. It might be as simple as that. Or it can be more complicated in this whole, political situation we've got going on with China right now. Pelosi going to visit Taiwan. Not advisable. I mean, this is going to piss China off. And if that's the case, they could take repercussions. And I think the market is pricing in none of that. It's just, oblivious to it because we continue to go up here the last few days, despite it looks like Pelosi going to go and visit Taiwan, which is going to break down U.S.-China relationships almost guaranteed. So what does that mean for a supply chain? What does that mean for all of this stuff? Is it pricing any of that in? That's not even on the radar of the news right now. Because the news, the market prices and stuff is a season on the news, but the news is always behind. The news is always, looking for the reason that the market, the stock is moving. It's behind. So, I mean, if you can figure out ahead of the news, the COVID thing, take us back to that. I mean, that writing was on the wall for months. So I can take you back to, if you're listening to Premarket Prep in January of 2020, I was scared to death of the virus that was happening in Wuhan. And I was like, this is coming here. I was warning my friends and they were laughing at me. But I'm like, this is coming. And I was stocking up and I literally was going to I remember sending my wife to Costco. And I'm like, you got to load up here because we're going to end up in lockdown or something because they've done this in Wuhan. I'm like, go and buy, just a pile of stuff. She comes back with $300 worth of stuff. And I was like, $300 worth of stuff? I'm like, that's going to get us through a week. I'm like, I'm talking about we're in trouble here. I'm like, go take $5,000 and go buy hard foods, and put them on your shelf. I'm not joking. And so we took all our books off our bookshelves, and we took off all this, and we just piled up and loaded up because we didn't know what we were getting into then. We didn't know what the death rate of COVID was. You can say, oh, this was, just stupid. But in hindsight, looking back at it, it was just being savvy because you didn't know what to believe in China. We didn't know if the death rate was going to be higher on this. We didn't know if they were going to keep us in lockdown. We didn't know anything. So I was very nervous about the markets, and the markets were sitting up near all-time highs. And I can remember I had my long-term portfolio, and I never buy insurance, but I was buying puts, and the puts were cheap. They were dirt cheap back in January of 2020. People were not pricing in any of this because the market's oblivious to it. It doesn't price in anything. It's dumb. So I remember buying SPY puts, and I remember buying puts on the airlines and puts on the cruise lines and puts on all this stuff. And I remember I went too short because I thought it was coming, and I went to Feb. So this was January. I went to the February expiration. Well, all my airline puts, my cruise line puts, all expired worthless because I was too early on the trade. So I'm like, screw it. I'm going out to June. I'm like, this thing's going to be here by June. So I lost on the whole first round of puts I bought. This is, be pre-COVID. And obviously, we know the market fell 35% coming up in March. But I went all the way out to June, and I loaded up the puts. And those hit. So I remember I bought 320 SPY puts for $6 or something for June. I closed those things out at 60 in March. So, and that was the hedge against my long-term portfolio. But I'd sold a lot of my long-term portfolio. I went up to high end of cash, and then I'm day trading it too. So I'm playing it on that side too. So March 2020 was my best month since probably the financial crisis. It was a really good trading month for me with the markets going straight down. But I stayed bearish too long, and then, I didn't get my portfolio back, and the market started to rip after that. So long story short, you can have opinions, and sometimes they're going to be right or they're wrong. But what I want to get to the point is everybody thinks the market is efficient, and it's not because it was pricing in none of that risk. Whoever is selling me insurance on SPY for $6 going out to June is not looking at the situation in China whatsoever at the time. And obviously the markets fell, and they fell 35% in March. So, that was a significant fall in 3 weeks. We were down one day, 2,000 Dow points. So there's opportunities. if you're just looking at the information that's publicly available.
So do you feel like the markets will always correct to what the news might or what's going on in the world?
I think so. It's just late. Yeah, it does. It figures it out eventually, and then it's just late. It's like the interest rates. I mean, we knew we were going into a rising interest rate environment, yet in November, December, they were still buying stocks.
Right.
We're still kicking up near all-time highs. I mean, what are people thinking?
Yeah.
So, I mean, again, and I always say this on the Premarket Prep show, I'm always early. I'm just have this, I'm early. You know, it's better be early than late, but I'm often too early. And I'm probably early on this other China situation here right now, too. But you know, if the rating's on the wall and it's an obvious trade, sometimes positioning yourself can have and be advantageous for you. So November, December, obviously, we had a rising interest rate environment, markets kept going up, but eventually, you get into this rising interest rate environment where they're raising interest rates up to catch up with inflation. Eventually, stocks are going to start to fall, and that's what we saw.
I have to. I'm early too, okay, and I've been looking at all of COVID, and my husband and I have talked about this many times. It's you see all the CERB payments that are coming out, the government paying people to stay home, doing all of this stuff, and the question that you have to ask yourself is who's paying for this? And exactly, there has to be a consequence to whatever, because there's for every action there's another opposite and equal action. It just happens that way. So when you're looking back at 2020, 2021, and the markets are continuing to go up, people are staying home, they're getting money from the government, it's obvious. It's so obvious that there's going to be a payback at some point here, and we're going to be put into a place where there's going to be inflation. There's going to be government printing money. There's going to be all of these things that are going to have to cover the costs of what we've been in for the last 2 years. And for us to just cover our eyes and think that that's not an issue, I think is negligent, if not silly on our part, to not be considering some of those things, right? And I guess the problem is how do you time the market? How do you time when that payback is going to happen? Because I remember even The Big Short, watching The Big Short, and he could see that financial crisis coming, and he sat getting margin call, going, what is going wrong? The market's still going up, but it should come down. And eventually it hit, but he had the pockets to hang on long enough to do it. So, how do you improve the timing?
I think that's the main thing. One, you're never going to get timed perfectly, and it's better to be early than late. But two, having the pockets to be able to do it means don't get yourself so big, like margined out on the short side, that you're all of a sudden, even though I'm making that bet against Bear Stearns, I'm not going all in. And look at my setup. I was like, what is my risk first? I always look at the trade. What am I risking? What is my possible return? Always looking at the risk first. So in that case, I was like saying, okay, I think this Bear Stearns go down. My maximum gain would be 100% if the thing collapsed, obviously. But my maximum risk I was looking at was 6.25. So, I mean, always analyzing that from the risk reward perspective. I mean, that's why sometimes if you've got a really bearish thesis on the market, maybe you do buy puts if puts are cheap enough. Maybe you're shorting stocks. Maybe you're doing a hedge trade. We could get into relationship-based trading maybe with this conversation. But a lot of times, I'm just trading, I'll put on, a bearish bet, but then maybe I'll hedge it with, some type of a bullish bet or something else. So, trying to stay that market neutral point. So I think there's a big difference. Like there's basically three types of trading. Overall, if you want to just group it all, there's day trading and short-term trading. There's like medium term, which you call swing trading. Some call it position trading. And then there's like long-term investing. So keeping those all separate as a trader is sometimes difficult. I mean, if you are, you got your day job and you're just, throwing in, your $100 a week or 2 weeks into your long-term investment account and just ETF, I mean, that's a good way to build long-term wealth. I'm a trader though. I don't have a day job. I have to rely on my alpha extraction from the market to pay the daily bills. So, so that's, so I've got to separate that. Sometimes I'll go and protect my long-term investment portfolio like I did during the COVID crisis that we had in January. And then obviously it came to roost in March of 2020. But, other times I'm just looking at the inefficiencies and trading stocks against each other, and trading news as well. I mean, the headlines, like right now, there's probably going to be, if you're just betting, there's probably going to be a breaking headline here coming in the next few days about something with China that Pelosi actually does visit Taiwan, that probably China's going to say something that's going to obviously be threatening to the U.S. in some way, in some manner. Not saying that they're going to go to war with us, but I'm saying they could escalate the trade war to a certain extent. There could be other things happening. There's going to be repercussions if Pelosi goes to Taiwan. So those headlines, just anticipating a negative headline coming from something in China, could be a tradable event. And then if you're ready for that headline and say, I think something like this could happen, when it breaks, you're already set up and ready to pounce. So sometimes you can actually wait for the headline, and then obviously you're trading right in the price discovery process of it because you're prepared for that headline. So a lot of time I would say some of my trading is just probably headline preparation, getting ready for what could potentially be a headline. Sometimes they're out of the blue, and then you obviously have to adjust for that. But a lot of times the major political headwinds, the writing has been on the wall for weeks ahead of them. So being prepared for that is probably the biggest aspect of being successful in trading that. So the timing of it can be tricky, but sometimes you can wait even till the headline if you're prepared for it.
Right. This is great. Now, you've mentioned a few times relationship trading. Can you explain exactly what you mean by that?
So you could take it back to classic pairs trading. I mean, Rob Friesen, Bright Trading, has and obviously been very involved with pairs trading for a long time. You can take it back. It's called statistical arbitrage. Really, you're looking at one stock versus another stock and what are their relationships to each other. The whole entire market is built on relationships. And you could say in the easiest example, Ford, GM, obviously two stocks in the automotive industry, they're going to correlate with one another. The banks, you got Bank America, and you got Citigroup, and you got then you've got Goldman Sachs and you got Morgan Stanley, maybe a little more grouped together. You've got your oil stocks, Exxon, Chevron, Conoco are all going to move together. So those are relationships. But then you have relationships across sectors where, you've got obviously interest rates affect the banks. So you can look at on any given day, if the TLT is trading strong, the banks are likely to be weak that day. Other things being equal, meaning that, there's no individual news on those stocks, that, just if this was the only event, the TLT is going to put, if it's strong, it's going to put downward pressure on the bank. So obviously that's interest rate related. So, I mean, just knowing the intricacies of those little relationships gives you an edge over everyone else because your average trader doesn't even understand that relationship. So, that's what taking the time in the first 6 months to a year, just understanding how everything is interconnected. We're not talking about coming and being a high frequency trader and doing ARB SPY versus, S&P futures, because the high frequency traders have that whipped. But, there's a lot of other relationships they don't have whipped. And, anything that's like pure arbitrage now, your Virtues and your Citadels have kind of got that whipped. But I mean, there's still opportunities for you as traders on the relationships that are a little bit, they're correlated, but they're just not one, so they're not perfectly correlated. So just understanding how everything is interconnected will give you an edge over everyone. I would say the majority of my trading, and I would say probably especially the day trading, 90% of it is based on relationships where I'm getting long one stock because another stock is doing this. I mean, oil's down, airlines typically up. In this environment, it might change because, maybe stocks are all moving together as the VIX comes higher, but as the VIX comes lower, those relationships become more pronounced. So, where obviously oil prices going higher is not good for airlines. So, and you can see it over the course of time. As oil is weaker, airlines will be stronger. So, I mean, there's, those relationships to go into too. But then you can just go even after COVID, we were doing these lockdown stocks versus, so there's new relationships, that are always developing. Where lockdown stocks or stay-at-home stocks or reopening stocks versus stay-at-home stocks. That was all fun too because that was all new relationships where the algorithms weren't programmed for it yet, and there was all kinds of alpha to extract from it.
For new traders, because over time you start to really start to understand, like you said, if oil is down, airlines most likely should be up, right? Or even cruise ships or things like that.
Yep.
But if I was a new trader just coming into the market, how would I start to learn? Where would I go to start to really understand how things correlate to each other?
Like your sources of that information?
Yeah, as far as, is it just more put the time into the market? Is there somewhere that you feel like
it's understanding. I mean, I've got, here, and it's all kinds of different, scenarios, but it's doing your homework. It's knowing what's coming up. I mean, The one thing that I probably do, well, we'll just take it away from relationships for a second here. But the one thing that I do well is I know what's coming up this week, which companies are reporting earnings, which companies are going ex-dividend, what's the major political uncertainty this week, what is, the driver, who's driving the bus this week, what is the sector that's driving the bus. Last week it was big tech earnings. This week, I believe it's going to be China. I think it's going to be later in the week, but I think it's coming. I mean, who's going to be on Mad Money? I mean, because Kramer is influential. So what's he going to be talking about? There's so many different, stuff that, is out there that you can get informed with, So typically what I do is, when I'm starting on my Friday night, I write down all the major companies that are reporting next week in the days. So like this week, there's like 1,000 companies reporting. So you're not going to write them all down. But I'm going to know that AMD is reporting tomorrow night. I'm going to know that, CVS is reporting on Wednesday. I'm going to know Thursday's cloud day. Probably 99% of day traders don't realize Thursday's cloud day. It is. Cloud stocks are all reporting. Twilio, Datadog, Hubs, Team, Net. I mean, there's Skyworks, Square's in there. It's a big day, to know that, hey, there's going to be those stocks. There tends, here's a strategy for you in itself. There tends to be a positive flow upwards. You can just say, buying into reports as people anticipate that, hey, this company might be doing good. So you'll see that, positive bias. I'll try to extract alpha from just that slow, steady climb that often stocks do ahead of their reports. So for instance, like we've got AMD reporting, we've got PayPal reporting tomorrow night. I was long both those stocks through the weekend. Both of those stocks gapped higher this morning, and I was able to extract alpha just from those. So, and I mean, there's no news on those. Actually, I think PayPal might have had some news. But
I think AMD has the chip bill as well, right? AMD.
Well, and that too. So there's a whole nother, exactly. So that's a whole nother, thing to consider. Maybe you want to be long chips right now, but they've had a good run. So is it going to be a rug pull on the news, buy on rumors, sell on news? But I love buying ahead of the catalyst, not necessarily knowing the direction, maybe selling right before the catalyst hits, because you don't know if there's going to be a rug pull on it. But when you have a catalyst coming, a lot of times there's that upward bias going into the catalyst, and that's where you can extract more predictable alpha. After the fact, it's a guess, because maybe they come out with the good earnings. You might be long a report going to report. They come out with the good earnings and they pull the rug out from under and sell the stock off on good earnings. That can happen, or they buy the stock on bad earnings. We saw that happen over the course of this earnings season. So earnings is always a crapshoot, but what's not a crapshoot is that there's usually a positive, a bias on those stocks going into it. Just like dividend, like knowing what it's going to pay or go ex-dividend. AT&T and Verizon tend to be very strong ahead of their ex-dividend dates and a week after. So I know those relationships, and I will extract alpha from those relationships. So I'm employing lots of little bets, never going all in on one stock. Lots of little bets across a variety of different strategies to extract consistent alpha.
And I think that's a lot.
Gotcha. I actually did something similar.
I think that's a lot of the.
I actually did something.
The misconception, I think, in the market where traders that are getting started or just beginning, they want to have the $1 million account to trade with today, right? It's even somebody like yourself doing this for 25 years, it's still not. There's never that all in play where you put your chips all in the center of the table. It's not poker, right? It is just developing a habit.
No, because what can happen? You could have one event. So rule of thumb for me is I never usually put more than, I would say, 5%, and it's probably more like 2% of my trading account's value into any one given stock, because stuff can happen. I was short Celgene. I'm short Celgene the day it got taken over. That sucks when that happens. But and obviously that's a number of years ago. Was it 3 years ago? But you short Celgene, gets taken over. So I remember I was short over the weekend. It was $63. I'm probably shorted off of, some type of statistical arbitrage play. Just an overnight trade, not a long-term short. Just happened to be shorted because I might have 50 or 100 overnight positions. Just happened to be shorted. And I'm looking at 65 and then 70 and then 75, 80, all in a matter of minutes. I'm like, what the hell? And then you see the headline, like, oh my gosh, it's getting taken over. I'm like, this sucks. So what do? You eat it. I'm trying to just, I'm looking at the price. I'm like, okay, I'm eating this. I'm not going to hold and hope it comes back down. It's getting taken over here. It's the headline's there. So you eat it and you move on. But if I was all in on that bet, it's a good way to lose a lot of your trading account. I think I lost 2 days of trading off of that, only because I probably only had 1% or 2% of my trading account in it. So, and maybe even less than that. But I remember thinking it's going to take a few days to make up. So is this an unlucky trade that you're short of stock? We could work the other way, come long the stock and gets taken over, and that's just bonus. So I mean, it's bad luck that you're short of stock that gets taken over, and it was out of the blue. It wasn't even like it was rumored. And you just you move on. But if you have all your eggs in one basket and you're placing a bet on the long side, and your stock goes bankrupt, or on the short side, and your stock gets taken over, worst case scenario, really. I mean, you can lose a lot of money. You can lose and a lot of like it'd take you a long time to make that up. So I don't like going all in on anything for those reasons.
Now, do you typically use stops, or because the way that I'm guessing your style of trading, you don't?
Yeah, no, I do. It's probably not hard stops because I'm monitoring, I'm sitting here. But some people would say, and for me, a lot of times I'll have 50 or 70 or 80 overnight positions, or I might, have, at the open, maybe I've got a bunch of positions. People are like, how do you manage that? How do you actively manage, these short-term trades when you have that many? One, like for instance, I do a strategy which came from Don Bright, who passed away 5 years ago. Obviously, Bob Bright founded Bright Trading. It's his brother. Don was excellent, learned a lot from him. He called it the Opg strategy, which is opening only strategy, where when a stock opens too high from its relative value where it should open, he shorts it, and when it opens too low, he buys it. I still employ that strategy and it works well. So he's basically enveloping where he feels the relative fair value should be. So sometimes you just get these crazy opens where stocks just open way too high relative to where they should be. So, maybe I get short a whole pile of stock. What I immediately do if I get a short a whole pile of stock in the open, I'm looking at what's my overall net position, and maybe I hedge it with SPY. So maybe I just grab and hedge it right away because I'm trying to extract that alpha. I don't want the market to continue to go higher and then I lose just because market's going up. My idea was to extract alpha from the inefficient opening where stock is opening too high relative to where it should open. But if you get short all this and the market goes up to it, well, then your alpha's all gone. So you want to try to stay, hedged in that strategy. But, the first thing I do when I get, I've got 50 or 60 or 70 positions, and we have traders in our firm probably have 200, 300, 500 positions. First thing I do is I'm going to the losers. I mean, winners kind of look after themselves, but I'm looking, okay, what's kicking my butt and what can I minimize damage on? So you're trying to minimize the damage on the losers while trying to let the winners ride a little bit or maximize those gains on the winners. That's the whole play, because you're going to be right and you're going to be wrong. There's nobody that's 100% right. There's nobody that's 100% wrong. It's how you do and how you manage your losers that will define your long-term success.
That's another big takeaway that you just said right there, and I love that. Your winners will take care of themselves. I don't know how often traders will look at their P&L and they'll go, I'm losing in this position. They start to feel those losses. And what do? They start closing out their winning positions to try and make up for some of the losses. And then they hang on to that hope that the loss will turn around instead of exiting the loss and cutting their losses and letting those winners run. That is a huge takeaway. Everyone that's listening right now, I hope you get that from what Dennis just said. That is, there's some good stuff here. Thank you for that.
I'm taking the exact opposite side of that trade. Mm-hmm. I'm taking the exact opposite side by cutting the loser and letting the winner run. They're cutting their winner short to finance their loser. Mm-hmm. So, and obviously been successful for 22 years, taking the opposite of that trade. And it's human nature to want to get your money back. Don't dare sell at a loss. It's human nature. So really, as traders, once you have the discipline, you're already ahead of 90% of other people out there because they won't take a loss. Mm-hmm. Some people will absolutely refuse to take a loss. They'll take that stock to the grave with them. I mean, this is, some obviously maybe not professional traders, but you're getting into, newer traders or long-term investors, absolutely refuse to take the loss. The stock will eventually come back. I will eventually get my money back. They believe that with their soul. And in a lot of cases, they don't come back. Some cases they do, and they're rewarded. And in a lot of cases, they do come back. But in the cases that they don't, you take a stock from 50 to 0. I mean, how, a little 10% gains you have to make up when you lose 100% on something. Mm-hmm. If you're equally weighted, it takes 10 of them. So, I mean, you got to be right 10 times, and that one time you're wrong, and the math isn't adding up for long-term success. So discipline is the number one thing, cutting the losers, realizing when you're wrong. How do you know when you're wrong? You start losing money. Now, you have to have, some, you can't just say, oh, every time I lose a nickel on something, I'm going to sell, you get chopped out of everything. But, it's about, having your pricing points and feeling when the momentum's on your side. And if it all of a sudden starts going the other way, obviously your thesis was wrong. So I'm trying to always feel the momentum, feeling the pendulum swing. It's swinging all the time. pendulum is swinging from, the longs, it's in favor of the longs. Oh, now it's in favor of the shorts. When you can time those swings and it goes the other way, those are very lucrative opportunities as well. But sometimes those swings can continue. You can just play along with those swings. Lots of momentum traders, very successful, just playing along and going with the momentum. When you're fighting that momentum, which is natural human tendency as well, it's difficult trading.
Well, I think even dollars and cents aside, if you sell all of your winners and you just have a whole portfolio of red losers, yes, you're down financially, but what do you think that does to your psychology the next day when you want to place a trade? When you wake up every single day, you see big red leering over your portfolio. It makes it very tough to start thinking more sensible, I think, going forward from that point and just kind of moving on.
Absolutely.
Yeah, the psychology game here, and it is, huge aspects, and that just drains your mental capital. So it's not just draining your physical capital, it's draining your mental capital as well. The one thing that I do well on my day trading is I start fresh every single, so I have overnight trades, and I've always said and I've done this for the last 10 years, from 11 to 2, it's chop hour. It's very difficult to really find inefficiencies, and I'm more of an inefficiency trader. I don't trade 11 to 2. And sometimes I've even moved that up, or sometimes I'm out by 10 o'clock even. But I always, in my day trading overnight accounts, my 24-hour account, I get to flat 100% cash, no matter what. No matter if I had a stock taken over, I go 100% cash in my day trading account, somewhere between 10 a.m. and 11 a.m. every single day. So then I'm starting fresh. And then I come back to my account, and start trading the close, because I like trading the open, I like trading the close, I like trading after hours, I like trading pre-market for the simple reasons, lots of inefficiencies there. And I like trading news. So, there's lots of, inefficiencies in that too. So, I'm there, and then I'm starting fresh and say 2:30, 3 o'clock. If it's an FOMC meeting, maybe I'm starting a little bit earlier. But for the most part, I'm starting fresh every day. So I'm fresh. I don't have these losers to worry about. Maybe I have a long-term investing portfolio that's down in some stocks, but that's not my bread and butter. You're not worrying about that stuff. You never let a trade go from one account to the other. And, this trading account is its own trading account, and it's going to be at cash at least every single day. I'm not saying everybody has to do that, but it helps, because then I'm starting with a fresh mental state that, okay, today is a new day.
I highly encourage every single person in the mentor group. I tell them, I go, listen, whether you could do it all at once, whether you have to build out 2 accounts over time, whatever you do, get to the goal of having those multiple accounts. Because I know for me, when I was first trading, it was all in the same account. I had long term. I got to see the long term be read every day. It was just horrible.
Yeah, it's all mixed.
It was horrible.
Can't separate it.
Let me ask you. We're running out of time, but let me ask you one more question for traders in your professional opinion. What do you think is a more valuable tool to have for a trader in the market? Would it be a big dollar account or discipline? What's a more valuable tool to have?
Discipline, 100% discipline. The dollar account will look after itself eventually. You can slowly build it up. I do say, though, if you're trying to be a professional trader, you're going to quit your day job, and all of a sudden become a professional trader. Very difficult to do unless you've got some serious wealth. So that's why you've got to go. There's lots of prop firms out there. I'm not just going to pitch Bright Trading. We're stocktrading.com, but there's lots of other prop firms too, where you can come in with 50,000 and then get you up to $1 million. You got $1 million of trading capital, you can do something with that. You make 10% a year, made 100 grand. Make 20% on your money, make 200 grand. Make 40% on your money, make 400 grand. So you can see how, having that leverage. You're trying to do this with a $10,000 account, make 100,000 a year. You're not going to make 1,000% every year. You're not you may be good, but those are unattainable numbers. So you're just not going to be able to do it. There's no way to make a living really with a $10,000 account. You might have did it in 2020. You might have even did it in 2021. You're probably getting punished in 2022 and finding out the hard way that I need to get my day job back. But, you absolutely do need capital to do this on a full-time basis. But start small, even if you decide like I did, back to 1999, I was at the professional trading firm, came in with the 50, up to $1 million worth of capital I could have traded, but I didn't throw it all in right away. I didn't go all in because I was learning. Take your time to learn. Don't expect to come in as a professional trader and think you're going to just make money right away and you're smarter than all the other trading people who are out there and been trading for years. It takes a long time. You've got to beat somebody else really to extract money from the markets. Yes, as stocks go up, there's wealth created in the overall market, which gives a little bit of pie for everyone. But in the years that the market isn't going up, in order for you to be profitable those years, you've got to take it from somebody else. So there's a lot of smart traders out there. So you've got to be careful and you got to take your time to learn. So I would say discipline is the number one thing. And obviously, you do need to be capitalized. So it is important to, if you're looking to do this professionally, to probably go to a prop firm where you can get some capital, unless you're independently wealthy.
Mm-hmm. Dennis, it has been an absolute pleasure having you on the show. You have been a wealth of knowledge. I hope that our listeners have gained as much as I have from listening to you. Thank you so much. And for any of your contact information, all that stuff will be in the description below. So if anyone wants to reach out to Dennis or to all of his stuff, it'll all be in the description below. So thank you once again. Greatly appreciate it.
Can I just pitch our event?
Yes.
I do have one educational event, so I'm going to pitch it out here. Premarketprep.com. So, which the pre-market show, if you go to premarketprep.com, we're doing on August 18th, we're doing an introduction to swing trading. So teaching you about swing trading with Joel Alcon, who I talked about, my mentor, Rob Friesen, who's president of Bright Trading, and myself. Spencer Israel is going to host it, and it's on August 18th at 12 o'clock. So you can sign up at premarketprep.com. So I'm going to pitch you one.
Absolutely. And the links will be in the description below, so you can check out that event down below.
And if you guys are not listening to Benzinga Pre-Market Show, I highly, highly, highly recommend you guys do so. Make sure you guys catch it one time, because it is addicting. Once you watch it once, you'll be back again. So check it out one time. I honestly think it's better than most TV stock market channels, just because there's a different take on it, especially for traders. There's not only the news, but also ways that at least to consider playing different strategies, different options on doing that, and actually taking advantage of the news as opposed to just blindly listening to what other people say. But again, Dennis, Dick, appreciate having you on. Tracy, always great to host with you. Dennis, we'll have to get you back one time in the future, because it's always a wealth of knowledge that you just cannot cover in a short amount of time. But appreciate you coming in, and thank you guys for listening each and every week to the Pivot Podcast. We will see you guys next week.